All right, Torsten, same question for you as we had for an earlier guest. Jay Powell said he believes it's going to come in at 2.9. So is this report actually meaningful if it comes in line or even cooler? Is the jobs report really the big show when it comes to Fed rate cuts?
No, this is very, very important because, as you said, the setup at the moment is that we have a slowing labor market, which Chris Waller talked about yesterday in Miami. Chris Waller even had a footnote in his speech where he gave a little preview of the employment report for August, because he said that the Fed has data from ADP that on a weekly basis shows that the labor market continued to slow going into August. So if we have a slowing labor market, and the data that we get here at 8:30 for PCE shows you that PCE inflation at 2.9. It may not look like a lot at 2.9. I mean, we can often ask the question, well, 2.9, 2.5, what do these differences make? Well, remember the Fed's target, as we know, is 2%. So given 2.9 is the highest level since February, that means that the labor market is going down and inflation is going up. And that is the definition of stagflation. And therefore, for the Fed, should they focus on the weaker labor market, which says there should be cutting, or should they focus on inflation going up, which says there should be hiking? So this is the debate on the FOMC. And Chris Waller clearly said yesterday they should be focusing on the labor market. But this is where the discussion is at the moment.
All right, Torsten, I'm not going to let you off the hook. I know there's two sides to this argument, but I want to get your take on all this. And also, we saw a stronger than expected GDP report yesterday. GDP on the second read coming in at 3.3%. So I know you're worried about stagflation, but we have the economy moving very well again at 3.3%. We do see a weakening job market, revisions showing 250,000 less jobs than previously expected in May and June. So those revisions are very notable. And of course, there's a chance for another revision coming up. But how can we worry about stagflation when the economy is performing better than expected?
Well, that's exactly right. That's also why the weakening in the labor market is a little bit puzzling. And Chris Waller's speech and other people who are in his camp, they are saying, well, yes, well, the economy may still be okay, but we still see the labor market slowing down because of the headwinds coming from tariffs and trade war slowing down growth over the coming quarters. So the issue continues to be, where should they put the weight? And if you ask about my view, I do think that they will be cutting here in September, but they are just not able to cut as much as the market is pricing at the moment, because the inflation problem at 2.9 is simply not 2. And that is a major challenge for the FOMC, because if they begin to ignore the high level of inflation that we still have, then the long end of the curve could become disanchored even more. We've already seen a very significant steepening in the yield curve. Inflation expectations 1 year out are predicting at the moment that inflation in 1 year's time will be 3.4. That's dramatically higher than 2. So that also means the markets begin to price in that inflation is going to be much more elevated for a much longer period, which means that it's a continuation of the last several years where we were hoping inflation would come down to 2, but inflation now sticks at very high levels. So the answer to your question, Frank, is I do think they will be cutting, but I think that they will just not be able to cut as much as markets are pricing at the moment.
Torsten, can I ask you a question about the bond market? People often say the bond market is smarter and deeper than the stock market. The stock market's obviously very close to all-time highs, the S&P hitting another one, crossing 6,500. What are we seeing from the bond market? The fact that we're sitting at 4.9 while we're seeing pretty sharp declines when it comes to the 10-year and the 2-year.
Well, in my view, very, very important thing that's going on at the moment is that the stock market is mainly driven by the AI story and the Magnificent Seven. Still today, they make up 40% of the index. We've never seen such a high concentration. NVIDIA is 8% of the index. We've never seen a single stock for the last 50 years have that level of weight in the S&P 500. So the S&P story is, do you believe in the AI story or not? And absolutely, earnings have been good this season for the tech companies, and therefore that's the tailwind to the S&P. Oh, in the bond market, there's a whole different story playing out, and that story is all about inflation. It's about the labor market. So it's a very inconsistent narrative in those two markets at the moment, and the bond market is clearly telling you that there is a problem with the yield curve still steepening more and more, partly because of inflation, also because of the fiscal challenges we have, and also because of this risk that maybe the Fed will cut rates a lot more. And if the Fed cuts rates a lot more, maybe that means that the Fed is willing to accept inflation that's going to be permanently higher. So that's why I think the answer to your question is very important for investors to think hard about what is the story being told in the bond market versus what is the story being told in the stock market.